Let's understand how do we carry out the accounting for sharing of profits in a partnership firm. Now, as I told you in one of the previous videos, in partnership there are partners. Let's take two only for the time being, right? And the terms relating to this partnership are contained in the partnership deed. Now there can be two situations. One, a partnership deed exists, and the second, it does not exist, right? Now normally the sharing of profits between these two people is to be governed by the provision of the partnership deed. If it exists, okay, then whatever is the ratio, let's say for example the capital introduced by, let's call him X and let's call him Y, is 10 million and Y is 18 million. Okay, if a partnership deed exists, that will normally provide you what is the ratio in which the partners have to share the profits. Let's say it says equally. Now if it says equally, it is immaterial as to what is the amount of capital which X has brought in or what is the capital that Y has brought in, right? Another situation can be, it might say that the profits have to be shared in ratio of share capital, right? If this is the case, you basically see what is the ratio of the share capital. In this case it is 10:18, or simply if you divide both these by 2, you can also write this as 5:9, right? But the nutshell provision is that if the partnership deed exists, then it has to be in terms of the relevant provision. If the partnership deed does not exist, okay, or if it is silent in the sense that it does not provide either of these two, right, then the profits have to be shared equally. Okay, so whatever are the profits or whatever are the losses, they have to be shared equally between the partners, right? Now let us understand what are the accounting entries in such a case. In a partnership, what happens is, just like any other business, you will have profit and loss account, right? Now this account can have two types of balances. One is when there is a profit, the other one when there is a loss. We know that the profit has a credit balance and the loss has a debit balance, right? So let's take, say for example, there is a profit of 100 in first example and there is a loss of 200 in the second example. Okay, and let's say X and Y share profits equally. Profit shares equally. Now let's see what are the entries which are to be passed. I will come to this profit and loss appropriation account concept in later on, but normally in in partnership account, what happens is that once you have a profit or loss as per the profit and loss account, this is transferred to an account called the profit and loss appropriation account. This account is mainly for the distribution of the profits to the partners. So first what you do is you transfer this profit or the loss, as the case may be, to the profit and loss account, profit and loss appropriation account. Now because this is a credit balance, if you have to debit it or negate it, you have to debit it. So you write it as profit and loss account debit 100 to profit and loss appropriation account 100. So by doing this, what you have done is you have reduced this balance to 0 because it had a credited balance of 100. You've debited it, right? And you've transferred this balance to a profit and loss appropriation account. Then basically this profit and loss appropriation account is meant for distribution of this profit to the account of the partners. And because we've taken that profit and loss are being shared equally, so if we have to reduce this P&L appropriation account, what do? We debit profit and loss appropriation account. I'm not using the complete words, you can do that, by 100, which is the total amount, and we credit the partner's capital account. So why are we crediting this? If you remember, the capital account has a credit balance, right? If you are crediting the partner's capital account, you are basically increasing it. So therefore you credit the partner's capital account. How much it has to be? It has to be shared equally. 50 here, 50 here, right? And you write here as to X's capital account to Y's capital account, right? Now if there's a loss, the entries are reversed because the loss has a debit balance, so you credit to P&L account, to profit and loss account, and you debit profit and loss appropriation account 200, right? Now profit and loss appropriation account is a debit account, so as you have to transfer this to the partner's capital account, what will you do? You will credit it to profit and loss appropriation account 200. Why? Because this had a debit balance, you've credited it. Now what happens? Think logically. Because of the loss, obviously the capital account of the partners go down, right? Capital account, as I told you, has a credit balance. If you have to reduce that balance, you have to debit it. So you will debit X's capital account and Y's capital account by 100 each. Why 100? Because we've told that the profit and loss share have to be distributed equally, right? If you like this video, hit the like button. If you want to share this with your friends, please do so on Facebook, YouTube, Google+, Orkut, wherever you are, and help us create an educated world. Thank you very much.